All these different things and more are reasons why we will likely see the BOC start to reduce interest rates this year. Their biggest fear is the rebound of the housing market, which is why they're holding things artificially high. But welcome to The Flow, Real Estate and Money Show, a show focused on helping Canadians understand the different elements of real estate, mortgage, and finance. The goal of our show is to provide Canadians with the tools, information, and knowledge to have more success when it comes to their investing and real estate related decisions going forward. My name is Alex McFadyen, and I'm your host. I can't wait to get you into the flow. Well, that's it. The BOC has made its announcement and made its stance quite clear for January of 2024. It's going to hold pat, but I think the most interesting news of the day for this week's Bank of Canada news is actually not just the fact that the Bank of Canada opted to stay steady in their resolve and stick with the overnight rate at 5%, but actually it was probably most surprising the fact that it didn't just put rate hikes on the back burner. It basically completely threw them out of the window. And what I mean by that is, in regards to the statements that came out, the BOC essentially said that it is now confident enough that inflation's back on the right track to not really publicly dwell on rate risk anymore. And that message came directly from the senior deputy, Carolyn Rogers, right after the BOC decided to leave its overnight rate at 5%. So with regards to today's conversation, we got a lot of ground to cover. We're going to talk a little bit about specifically the announcements that happened, but more importantly, what that means for the market and the forward markets going forward. And there was another big drop today, which was the monetary policy report, which essentially outlines a summary of the economic events which have been unfolding over the course of the last couple of months. And there were some key takeaways in this monetary policy report that would be impactful from a money and a housing perspective. Some interesting visuals and some graphs that I want to really just briefly touch on here today. Maybe some are surprising, maybe some are not. But for anybody listening to this podcast, you're obviously interested in money, you're interested in real estate, you're interested in mortgages. Well, this is definitely going to be worthwhile to have a listen in on. And I'd love to get some feedback here as well. If you're enjoying the show or the podcast, send me a DM at Flow Mortgage Co on Instagram or at The Mortgage Pug. Let me know if you're liking the episode, the show, once you finish it up. And of course, make sure to give me a review or rating on iTunes or Spotify. So without further ado, let's get right into it. The first things first, the BOC had a large shift in regards to how they were really approaching the conversation around interest rates and overnight rates from the Bank of Canada. Instead of talking about the potential of still raising interest rates, they're basically said that they're going to start focusing on shifting how long the overnight rate needs to marinate at its current level at this point right now. And for those who have been paying attention to the BOC rate hikes, which has virtually been everybody, in fact, some of my clients were telling me that even their grandparents are now listening to what's going on. It's been, for the past series of rate pauses, this will be the fourth one in a row, still a conversation around the fact that there is a possibility of actually even increasing the overnight rate. So, I mean, I think this is a pretty big change, and it's definitely a change of sentiment, and it's something that should be considered and noted if we're looking at how they're assessing rates going forward. Now, some other key quotes from this that you're going to want to know. Macklem said, "We need to give these higher rates time to do the work," which is a reminder that they're not going to drop rates probably here in March. In fact, most of the forward markets are thinking that it's going to take anywhere from about 4 to 6 months for the BOC to really kind of take their foot on the gas, off the gas, and start to actually lower interest rates. From a projection timeline, that doesn't put us into March or April. That actually moves us out to about June being the very first time that we potentially could see the BOC offering rate drops. Now, if we're thinking about rate cut projections and expectations after today, this is just a quick little summary of what it could look like. We could look to see, and I actually believe that we're going to see this in very small drips, by the way, not a large drop or anything of that nature. What it could look like is it could look like a June quarter point drop, which would put us at 4.75, followed by September at 4.5%, October 4.25%, and then January of next year, if things continue along that smooth path where we see things start to kind of work their way back down. I mean, the bank basically says that higher rates themselves can't be ruled out, but Historically speaking, it's extremely rare for the Bank of Canada to hike again after pausing for 5 months and then pausing again and then hiking again. Like that would be such a surprising outcome. It's just really unlikely that we'd see that occur. Now, although there's no specific timeline for the timeline at which high interest rates will persist, like again, historically speaking, they've remained at peak levels for varying durations from a few months for up to 18 months. And, we're going on right now into February of 2024 with interest rates having remained high now for multiple years, and specifically having had about, like I said, 5 months of rates remaining pretty well pat. So we're getting kind of towards the end of the normalized historic cycle, of which point we'd see interest rates start to come back down. So what's been the reaction? The reaction in the marketplace has been really interesting, to say the least. Now, if you can recall, one of the big indicators of where fixed rates will go is the Canadian mortgage bond. And specifically, if you're looking at ways to look up when and how rates are going to go up or down, you can look up the 5-year Canada bond. And what's been interesting to note is that we hit the absolute highs in the 5-year bond in October of 2023. I mean, that's when we were seeing fixed rates around 6.8, 6.9, almost 7% across the board. But since that time, there was a steady decline, specifically notably in December of 2023, where we saw the 5-year bond drop down to 4% from the highs. The highs were over 4.5, by the way, around 4.6. And we dropped all the way down to 4% in December. And then, believe it or not, all the way into the beginning of January. So the first week of January, we saw the 5-year bond yield hit the lows of about 3.1 to 3.2%. And from a mortgage rate perspective, that's huge. I mean, we saw that happen. And although we didn't actually see the banks offer substantially lower advertised rates yet, they were offering something we call discretionary rates, which is basically where they keep the advertised rate higher and then they lower interest rates behind the scenes. Either way, we were seeing banks like TD go from rates of 6.75, 6.85, all the way down to like 5.5%. And sometimes even lower on a 30-year amortization mortgage. Some pretty amazing stuff. But over the last few weeks, there's been a little bit of a turnaround. And what's happening is the Canadian mortgage market has been buoyed by what's happening in the US. So like as a stark contrast, we've been seeing up here across north of the border a lot of recessionary measures. And, we're hardly adding any jobs. We're seeing inflation really come back down outside of what's happening in the rental and the mortgage market. And in the US, spending is still coming in extraordinarily high. Now, there is a suggestion that what's happening in the US is just about 4 to 6 months away from cooling off and starting to burn like what we're seeing here in Canada. But until that happens, we've actually seen our bond yield jump back up again, another 0.5% to about 3.7, 3.8% on the backs of what's happening down there. So from a rate perspective, we're seeing fixed interest rates slightly increase a little bit higher, back to closer to where they were, let's say, in the end of December. And that equates to say, for example, the benchmark rate, which is the most common rate right now, being a 3-year fixed, hovering in and around that high 5 range. And that's kind of what we're seeing across the board with most of the banks and lenders right now for a conventional uninsured mortgage, which is when you're putting down 20% or more. Now, kind of back to the announcement here, as I mentioned, like there's a stark contrast right now between what's happening in the US and what's happening in Canada. And, even since this time, there was a US spending report that came out actually just recently at the Friday. And in that spending report, the crazy thing is like I said before, US spending, although there were some signs of it going down, is actually up again across the board. And here's the crazy thing, and this actually blew my mind. US spending is very high in gambling. Gambling is hot right now. And I mean, there's a lot of theories as to why and what, but one of the theories is that in the US markets that we see people who are trying to win back money and, or some of those that are concerned, they turn to gambling instead of investing. their money in hopes that they are actually going to make some more money back. But it's an extreme high, and it's one of the one areas in the U.S. where spending continues to be high, among others such as the ever so popular buy now pay later scheme, which is becoming an issue. And that's another reason why there's a lot of pundits out there suggesting that we start to see the U.S. follow Canada in the ways of inflation and the market itself and the economy slowing down later this year. Now, speaking of inflation, again, as we suggested, inflation in January has recently increased, but the BOC expects the actual spike to be temporary, somewhat perhaps on the backs of what happened over Christmas time. But again, we can't forget the fact that the inflation that we're seeing right now, a lot of it is heavily weighted on mortgage and interest rate increases, which is kind of like a self-fulfilling prophecy. Rates are high, people are renewing at higher rates, rents have gone up dramatically due to higher population growth. And yes, so of course, we're going to see inflation and rental inflation, the portion of rent and mortgage inflation be up. So it's like a negative self-fulfilling prophecy. And we'll wait to see what happens if that changes. In addition, our overall GDP is in the tanks. And like for all intents and purposes, we're in some form of a recession right now. So there's just so many conflicting numbers, and this all of these things. The whole point of having this conversation is that all these different things and more are reasons why we will likely see the BOC start to reduce interest rates this year. Their biggest fear is the rebound of the housing market, which is why they're holding things artificially high. But eventually, there are just too many people that are going to be coming up for renewal towards the end of 2024, 25, 26. They're eventually going to start to reduce interest rates because it's almost a self-fulfilling negative prophecy if they don't. So looking forward, what does it look like as far as the markets and what are some of the risks that we're seeing? There's a few factors like immigration and wage growth and supply shocks and real estate activity, and all of these things could have an impact on where the market ends up going and what happens in the real estate space, but more importantly, the BOC. And there's just so many different factors that could be a part of this. Specifically, like I said before, the bank said that overall mortgage interest costs are the biggest contributor, and that's one of the things that they're watching out for the absolute most. So again, if the real estate market picks up, we could see things stay a little bit higher for longer, which is what no one wants to see. So, in light of what's happening recently, the projections, the benchmark itself has been moved forward, and the predictions of rate cuts are moved forward up until June. So what is somebody going to do? Like what's somebody to do as far as mortgage options are concerned, and what are their options to consider? At this time right now, for a lot of people right now, obviously they're seeing a pretty dramatic increase to their monthly payments if they're renewing or refinancing. And now there's some things that you can do, such as re-amortizing your mortgage. Re-extending the amortization is obviously not something that everyone wants to do. But, at the end of the day, when it comes to cash flow, that's probably something that a lot of people should be considering at this time, at least something that you can do. You can also consolidate, obviously, high cost debts and expensive costs. But we're still considering that the 2-year and the 3-year fixed term are probably the best outlook for anybody who's financially a little bit unstable or wobbled. Now, the difference between the 2 and the 3-year in terms of interest rates is about 0.4% today. So there is a notable difference. But at the end of the day, the question mark is, how fast we see rates come down, not whether or not they come down. And so for a well-capitalized borrower or more well-capitalized borrowers, we're seeing them continue to choose the short terms, and in some cases even picking adjustable rate mortgages. Reminder, there's a difference between variable rates and adjustable rates at the end of the day, but we are starting to see people start to move towards those variable rates and shorter terms. For some of those more conservative on the outlier, they're looking at 3 years. But I will say, for anybody who's considering term length right now, if you're going to go 3 years or greater, you really need to look out for the interest rate differential penalty. And if you're not familiar with the IRD penalty, this is the prepayment penalty, the penalty that you pay back to the lender to essentially recapture the lost interest. Some of those lenders are increasing their posted rates, some of the big banks like RBC notably. And what that's going to do to a borrower who's going with a bank like that is that's actually going to massively increase their potential prepayment penalties. in case they opt to, let's say, refinance or sell or restructure the mortgage before the end of the term. And for me, I think that's one of the biggest takeaways for somebody who's getting into the mortgage rate market right now is ask your bank, ask your broker, what is my IRD penalty and how is it calculated and what could that do for me? Because again, in 2021, when everybody wanted to refinance their mortgage and reduce their interest rates because rates were coming down, of course, why wouldn't they? I mean, that was the one thing that stopped people from being able to do it. It ended up costing them, $10,000-$20,000 in interest costs. So, I mean, be less concerned about a 10 point or a 20 point difference in rate when you have the opportunity to find an institution or a lender that's going to be more favorable for you, because the difference could be, paying $5,000 versus paying $45,000, right? And, that tenth of a point in interest rate is going to mean squat if it comes down to breaking your mortgage early, or the potential to save 1.5% or 2% interest to get out of your mortgage early. Now, moving over, we talked about this monetary policy report, and there were a couple of key points in there that I really wanted to point out. But the one big one that stood out to me, and obviously this isn't a visual version, but you might be able to look this up if you just search up monetary policy report and you look up inflation and expenses, so rental expenses as it relates to housing costs. And this chart shows that specifically population growth is like a direct correlation between population growth and rental prices. And the crazy thing about that is, again, it's almost like a hockey stick level up from when we saw the population growth occur towards the end of 2021. And the funnel just opened up into the marketplace. Like on one shot, we're showing population, year-on-year population growth just go up. And then we see affordability and vacancy rate just go completely opposite direction and go back down. So what'll be curious to note is some of these rule changes with regards to international students. How much does that actually impact rental rates, and where does that come in? I mean, I don't think that between that and the short-term rentals that there's going to be a dramatic change in rental rates per se. I think the damage is already done. I still think we don't have enough housing, but it is really interesting to note that they're actually showing this on a freaking hockey stick related graph to say, hey, yeah, we brought a whole whack load of people into the country and we didn't have enough housing, and therefore there's higher rents. Like, big freaking surprise, right? But to see it is another thing altogether. It's really interesting to note that. And again, kind of looking forward here, this isn't about building or anything like that, but that is and continues to be one of the big challenges and themes for 2024 is like what's happening with building. Like right now, apparently we're only building 1 in 4 of the potential single family homes that we need to build. We're still under building just in general. So where do people go? What happens? At what point do people say, screw it, we're moving elsewhere and we're getting out of here? Anyways, I don't want to make this all negative. I wanted to make this about the BOC and what's expected. The next announcements coming up in March of this year. I don't expect any major changes unless there's a significant change in regards to sentiment between here and there or some significant reports. But at the end of the day, this is a positive sign for those people who are stressed out about their mortgage, about their monthly payments, who are maybe making interest-only payments or not even that. And another reminder or another sign that this too shall pass and things will definitely get better. We just keep reminding people when we're heading into any recessionary times, it's just like the number one thing you can do is just get a grasp on your strategies, your financial plan, what you're doing with your money. Are you tracking it? Are you looking at how you're spending it? At the end of the day, it's usually the principles that save you money. If you have a financial planner, do you trust the plan that they're making right now? How much money are you paying in fees and expenses? It's not a bad thing to pay somebody to do that work for you. It's just not a good thing if you don't know what you're doing and where your money is going. So figure out where your money is going. Get interested in money. Start looking into how you're investing and what you're investing into and why you're investing into those types of things. And you'll definitely benefit from a financial consideration moving forward. Anyways, guys, I hope you enjoyed this brief episode here today. If you did, definitely send me a DM, hit that like button, share the podcast. Let me know. We'd love your feedback. And I'll see you on the next couple episodes because we have some bangers coming up. Talk to you soon. That was an unreal episode of The Flow. I hope you enjoyed it as much as I did on my side right here. If you haven't already done so, make sure to check out all of the incredible resources that we have available. You can find us on Instagram at Flow Mortgage Co. You can find us on our website, getflowmortgage.ca. And of course, don't forget our free first-time homebuyer masterclass that's currently available on our website for anyone who listens to the episodes. And if you loved what you listened here today, the only thing that we ask for is to share this with someone else that you think this could help. And hey, maybe leave us a great review online.